Rome didn't fall overnight. Its money failed first. When people think about the fall of Rome, they imagine invading armies, corrupt emperors, or burning cities. But Rome wasn't destroyed by a single battle. It weakened from within, and one of the main reasons was the collapse of its money. For centuries, Rome relied on the silver denarius, first minted around 201 BC. It was trusted because it contained real silver. Soldiers earned it, merchants accepted it, and families saved it. The coin wasn't just money, it represented confidence. But empires are expensive. Armies had to be paid, borders defended, and massive public projects financed. By the 2nd century AD, spending had outgrown tax revenue. Rather than raising taxes, emperors chose an easier path. They reduced the silver inside each coin, while keeping its appearance almost unchanged. Under Augustus, the denarius was about 95% silver. Over time, that figure kept falling. By the reign of Gallienus, only a tiny amount remained. The coin looked the same. Its value didn't. People noticed. As more debased coins entered circulation, prices climbed. Merchants charged more, workers demanded higher wages, and families found their savings buying less every year. Many traders abandoned the currency altogether, preferring gold or barter. The government's solution only deepened the crisis. It minted even more low-value coins. More money, less value, higher prices, lower trust. The cycle repeated itself. By the 3rd century, Rome faced invasions, civil wars, disease, and political chaos. Beneath it all was a broken financial system. Taxes collected in worthless coins lost purchasing power. Trade slowed, farming declined, and local economies weakened. Emperor Diocletian tried to stop the crisis in AD 301 by fixing the prices of thousands of goods. Anyone charging more faced severe punishment. It failed. No law can make people trust worthless money. Goods disappeared from official markets, black markets expanded, and the economy continued to decline. Constantine later introduced the gold solidus, restoring stability in the Eastern Roman Empire. For the West, it was too late. Its economic foundation had already collapsed. Rome's story didn't end there. History repeated it. After World War I, Germany printed enormous amounts of money to cover its debts. By 1923, hyperinflation had become so extreme that people rushed to spend their wages before prices rose again. Savings disappeared, while those owning land or real assets protected much of their wealth. Zimbabwe followed the same path decades later. As the economy deteriorated, the government relied on the printing press. Inflation became so severe that the national currency was eventually abandoned. Different countries, different centuries. The same mistake. Even modern economies face similar temptations. In 1971, the United States ended the dollar's link to gold, turning it into a fiat currency backed mainly by trust. Since then, debt has grown dramatically, money supplies have expanded, and purchasing power has steadily declined. The bills look the same. Their value does not. Inflation rarely arrives overnight. It quietly reduces purchasing power until people realize their money no longer buys what it once did. Governments often present inflation as growth. Higher wages sound encouraging until prices rise even faster. Expanding debt is described as investment, even when it mainly finances current spending. The pattern changes. Its logic doesn't. Today's financial system is even more connected than Rome's. Rome faced an imperial crisis. Germany faced a national one. Zimbabwe faced a domestic one. Tomorrow's crisis could spread across the world. So what should we learn? First, money depends on trust. Once confidence disappears, economies begin to unravel. Second, real wealth isn't just numbers in a bank account. Skills, productive businesses, land, and valuable resources tend to hold their value far better during inflation. Finally, never assume stability is permanent. Romans believed their empire would last forever. History proved otherwise. Rome wasn't destroyed in a day. Its financial foundation eroded for decades before its political collapse became inevitable. By the time enemies reached the gates, much of the damage had already been done from within. That's the real lesson. Empires rarely die only by the sword. They are first weakened by the slow destruction of trust in their money. History doesn't repeat itself exactly, but it never stops warning us. If this video gave you a new perspective, consider subscribing. History doesn't just explain the past. It helps us prepare for the future.